On a Sunday evening in March 2020, before markets could even open, the Federal Reserve cut interest rates to zero and announced $700 billion of bond purchases in a single emergency statement. Within 2 weeks, the buying became unlimited. Most people watching the news that night couldn't have named the tools being used, let alone the order they're deployed in. That's what this video fixes. The central bank playbook has 5 core tools. We're going to open the box and examine them one at a time. Every major central bank, the Fed, the ECB, the Bank of England, the Bank of Japan, the Swiss National Bank, runs the same basic mission: keep inflation near a target, usually 2%, without strangling the economy. To do it, they escalate through a toolkit that runs from routine to radical. Think of it as a ladder. Tool 1 gets used every cycle. Tool 5 has only appeared in extreme circumstances. For each one, we'll cover what it is, when it comes out of the box, and one real deployment. Let's start at the top. The policy rate is the interest rate on overnight money between banks. In the US, it's the federal funds rate. It's the anchor for everything else: mortgages, business loans, credit cards, currencies. Raise it, and borrowing cools. Cut it, and borrowing revives. This is the everyday steering wheel, used in every cycle since central banking began. The most famous deployment is Paul Volcker's war on inflation. In 1980, US inflation hit almost 15%. Volcker pushed overnight rates to nearly 20% by 1981. It worked. Inflation fell below 4% by 1983, but the cost was a deep recession and unemployment near 11%. The lesson stuck: the blunt tool works, and it hurts. The modern echo came in 2022 and 2023, when the Fed raised rates from 0 to about 5.5% in 11 moves over 16 months, the fastest campaign since Volcker himself. One more modern twist: the floor turned out not to be zero. Several European central banks pushed policy rates negative in the 2010s, and Switzerland held the world's lowest rate, -0.75%, for nearly 8 years, effectively charging banks to park money overnight. Tool 2 costs nothing and moves trillions. Forward guidance is the central bank using words as policy, promising where rates will go, so markets price the future today. It matters most when rates hit zero and there's nothing left to cut. If you can't lower today's rate, you can promise to keep tomorrow's low. The Fed leaned on this hard after 2008, at one point pledging to hold rates near zero until unemployment fell below a stated threshold. Numbers in a press release became policy instruments in their own right. The legendary deployment happened on July 26, 2012. The euro was fracturing. Borrowing costs for Spain had climbed above 7%, a level that had already forced other countries into bailouts. Then ECB President Mario Draghi said one sentence: "The ECB is ready to do whatever it takes to preserve the euro." And believe me, he added, it will be enough. Spanish and Italian yields collapsed over the following months. The remarkable part: the rescue program behind that promise was never activated. Not €1 was spent. Credible words did the entire job, which is why every central bank now drafts its sentences like weapons. When rates are at zero and words aren't enough, the balance sheet comes out. Quantitative easing means the central bank creates new bank reserves and uses them to buy long-term bonds, government debt, and in the US case, mortgage securities. The goal is to push down long-term yields, the rates that mortgages and corporate borrowing actually follow. It's not cash mailed to households. It's a swap that floods the financial system with liquidity. The mechanism is called portfolio rebalancing. When the central bank vacuums up safe bonds, the investors who sold them go hunting for yield elsewhere, in corporate bonds, mortgages, and equities. Financial conditions loosen across the board. That's the entire point, and it's also the standard criticism, that QE lifts asset prices first and the real economy only second. Japan pioneered it in 2001, fighting deflation. But the defining deployment came from the Fed in November 2008, with the system collapsing. QE1 started at $600 billion and grew to roughly $1.75 trillion. QE2 followed in 2010, QE3 in 2012. The Fed's balance sheet went from under $900 billion in 2007 to about $4.5 trillion by 2015. Then March 2020 dwarfed it all. The balance sheet roughly doubled again, peaking near $9 trillion by early 2022. The ECB ran its own versions, buying €60 billion a month from 2015, then adding a pandemic program with an envelope of €1.85 trillion. QE is QE in reverse, and it's younger than most people think. The central bank lets bonds mature without replacing them, shrinking its balance sheet and draining reserves back out of the system. It's used when the emergency is over and policymakers want room for the next one. Note what QE usually isn't: outright selling. Central banks mostly just stop reinvesting and let time do the shrinking, precisely because active sales into a live market could trigger the sort of panic they exist to prevent. Deployment 1, 2017 to 2019, was the first real experiment. The Fed let up to $50 billion roll off per month. Janet Yellen predicted it would be like watching paint dry. It was, until September 2019, when overnight funding markets suddenly seized and some repo rates spiked toward 10%. Reserves had quietly become scarce, and the Fed had to stop and reverse. Lesson learned: QE is boring right up until it isn't. Deployment 2 began in June 2022, twice as fast, with caps reaching $95 billion a month. By 2025, well over $2 trillion had run off, taking the balance sheet from about $9 trillion toward the mid-sixes, and the pace was deliberately slowed as reserves declined. Nobody wants to rediscover the 2019 lesson at scale. The rarest tool doesn't target an amount of buying. It targets a price and promises unlimited buying to defend it. Yield curve control means pinning a specific bond yield, say the 10-year, at a chosen level. There's a wartime precedent. The Fed capped long U.S. Treasury yields at 2.5% from 1942 until 1951 to finance the war cheaply. But the modern deployment is Japan. In September 2016, the Bank of Japan pinned its 10-year yield near 0%. The paradox is elegant. If markets believe the cap, they won't test it, so the bank can hold the line while buying less. It held for years, but exits are the hard part. In December 2022, the bank widened the band and the yen swung violently in hours. In March 2024, Japan finally scrapped the cap and raised rates for the first time in 17 years. Total control of a price, it turns out, is easy to declare and delicate to release. Now assemble the box. Easing runs in order: cut the policy rate, guide expectations, launch QE, and in the extreme, cap yields. Tightening runs in reverse: taper the buying, hike the rate, then let QE grind in the background. Rates are the scalpel, the balance sheet is the tide. And notice one thing across every cycle since 2008, the toolbox never quite shrinks back. Balance sheets stay structurally bigger than before each crisis. Whatever the next downturn looks like, you now know the order in which the tools will come out. Recap. 5 tools. The policy rate steers everyday credit, proven by Volcker at 20%. Forward guidance moves markets with sentences, proven by Draghi in 2012. QE buys bonds to crush long-term yields, from $600 billion to a $9 trillion balance sheet. QE drains it back out, gently, after the 2019 repo scare. And yield curve control pins prices outright, mastered and finally released by Japan in 2024. Central banks drive every cycle we cover on this channel. So if you want to understand the next cycle before it arrives, subscribe. Next episode, we leave the machinery and enter the mind, fear, greed, and the psychology that powers it all. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.